IPOs can become a trap for retail investors because the incentives, pricing, allocation process and investor behavior can work against them. Why IPOs can be a trap for retail investors in India. An IPO is not inherently a scam. It is a legitimate way for a company to raise capital from the public. However, the way retail investors often participate in IPOs can create a serious mismatch between perceived opportunity and actual risk. 1. Oversubscription can create an illusion of demand. When an IPO is subscribed dozens or hundreds of times, many retail investors interpret this as proof that the company is highly attractive. But subscription numbers primarily tell us how much demand was submitted at the IPO stage. They do not prove that the company's valuation is justified or that the stock will perform well after listing. During the 2020-21 period, for example, many Indian IPOs experienced extraordinary levels of oversubscription, with several issues receiving more than 100 times the number of applications needed. This can create a psychological cycle. High subscription, fear of missing out, more applications, even higher subscription, stronger perception of demand. 2. Getting the IPO price is increasingly difficult. The headline IPO price can be misleading for the ordinary retail investor because extremely high demand can make allotment very difficult. Historical evidence from SEBI has also shown that IPO allocation mechanisms have previously been exploited through fictitious or Benami accounts to corner shares meant for genuine retail applicants. SEBI's investigations found instances in which operators accumulated retail category allotments and subsequently sold the shares after listing. Although regulations have evolved considerably since those cases, the historical record demonstrates an important point. The IPO allocation process itself can create opportunities for sophisticated participants that ordinary investors do not have. 3. The listing gain is not the same as long-term wealth creation. One of the biggest misconceptions among retail investors is, if the IPO lists at a premium, I have made money. That is only true for investors who actually received an allotment and can sell at that price. Research examining Indian IPOs has found that IPOs can produce positive initial returns while their longer-term performance is much more variable. One study covering Indian IPOs from 2012 to 2022 found positive listing day performance but significant differences in wealth creation over longer periods. Therefore, a spectacular listing does not establish that the underlying business is worth buying at that price. 4. Retail investors can end up buying after the easy money has already been made. Suppose an IPO is issued at 100 rupees and opens at 150 rupees. The investor who received shares at 100 rupees has a potential 50% gain. But the retail investor who did not receive an allotment and buys at 150 rupees has a completely different investment proposition. If the stock later falls to 100 rupees, the first investor has potentially made money while the second investor has lost 33% from the purchase price. This is why listing gain and investment return should never be treated as the same thing. Recent analysis of SME IPOs provides a particularly clear illustration. Extremely high subscription levels did not necessarily translate into superior returns for investors who bought after listing. 5. High subscription does not necessarily mean good valuation. A company can be an excellent business and still be a bad investment at an excessive price. The important question is not, is the company good? It is the company good enough to justify the price I am paying? Retail investors often focus on revenue growth, brand visibility, oversubscription and expected listing gains while paying less attention to valuation ratios, cash generation, debt, return on capital, promoted transactions and the actual use of IPO proceeds. A fundamentally strong company purchased at an unreasonable valuation can still produce poor investment returns. 6. IPO marketing can make investors focus on the story rather than the numbers. Before an IPO, investors are exposed to a carefully prepared investment narrative. Rapid growth, a large addressable market, expansion opportunities, industry leadership and future potential. None of these automatically guarantees shareholder returns. The IPO prospectus contains extensive financial and risk disclosures, but retail investors may concentrate on the attractive parts of the story while overlooking risks buried in the financial statements and disclosures. The result is a common behavioral problem. Investors buy the story first and investigate the valuation later. 7. SME IPOs can carry additional risks. The risks can be more pronounced in SME IPOs because smaller companies may have shorter operating histories, smaller businesses and more limited liquidity than established main-board companies. Recent regulatory discussion has also acknowledged concerns surrounding misuse of certain SME framework relaxations, including cases where issue proceeds were allegedly diverted to related parties or promoter-controlled entities. SEBI is currently reviewing the regulatory framework for SME IPOs, including issues related to market making and the functioning of the segment. That does not mean every SME IPO is problematic. It means investors should recognize that smaller company IPOs require substantially more due diligence and liquidity awareness. 8. Liquidity can become a hidden risk. A stock can appear attractive when it is rising because there are plenty of buyers. The real test comes when investors want to exit. For smaller listed companies, relatively limited trading activity can make it harder to sell a meaningful position at the desired price. A quoted market price does not necessarily mean that an investor can liquidate a large holding at that exact price without affecting the market. This makes "can I buy it?" a less important question than "can I exit it at a reasonable price if my investment thesis is wrong?" 9. Retail investors are particularly vulnerable to FOMO. The psychological element is perhaps the biggest trap. When investors see huge subscription numbers, gray market premiums, social media discussions, predictions of massive listing gains, stories of previous IPO winners, they can start treating an IPO like a limited time opportunity. That encourages investors to ask "how much can I make?" rather than "what can go wrong?" Academic evidence on Indian IPOs has also linked increased retail participation and optimism with speculative behavior and reliance on short-term indicators rather than company fundamentals. The real problem. So the strongest evidence-based argument is not IPOs are scams designed to steal retail investors' money. That is too broad and cannot be supported as a general statement. A much stronger argument is IPOs can become a trap for retail investors because the combination of aggressive marketing, oversubscription, allocation uncertainty, listing day speculation, high valuations and FOMO can encourage investors to focus on short-term gains rather than the underlying economics of the business. There is also an important distinction between the company raising money through an IPO and an investor making money from the IPO. The company may successfully raise capital even if the stock subsequently falls. The investor's return depends on the price paid, the company's future performance and the valuation at which the shares were purchased. IPOs should therefore not be viewed as guaranteed wealth creation opportunities or as scams by default. They are capital market transactions in which the retail investor must accept valuation risk, business risk, market risk and liquidity risk. The biggest trap occurs when investors mistake oversubscription for quality, listing gains for sustainable returns, and popularity for fair valuation. Evidence from Indian markets shows that IPOs can generate strong short-term returns, but those returns are not automatically sustained over the longer term. For a retail investor, the most important question is therefore not how much is this IPO subscribed, but what am I paying for this business, what can go wrong, and would I still want to own it if there were no listing day hype?